Choosing a business structure can feel confusing at first, but it doesn't have to be. At its core, picking the right entity is about deciding how your business will be taxed, how ownership works, and how protected and liable you are if something goes wrong. Get this decision right early, and you set your business up for long-term success. But if you get it wrong, you could be dealing with unnecessary taxes or limitations later on. Here's a straightforward breakdown of the differences between C-Corps and S-Corps to help you determine which is right for you. Business entities are the legal framework behind your company. They determine who can own part of the business, how profits are taxed, and your personal asset liability. For these reasons, corporations are a popular option to many entrepreneurs. The two most common types of corporations are C corporations and S corporations. They look similar on the surface, but they operate very differently behind the scenes. Let's start with C corporations. A C Corp is the default type of corporation under US tax law. It's designed for companies that want flexibility when it comes to ownership and investments. C Corps can have an unlimited number of shareholders, and those shareholders can include individuals, other companies, or even foreign investors. This makes C Corps the structure of choice for larger businesses and companies planning to go public one day. As you can see, C Corps are flexible, but that flexibility comes with a trade-off: taxes. C Corps are subject to what's known as double taxation under the Internal Revenue Code. First, the corporation pays taxes on its profits at the corporate level. Then, when profits are distributed to shareholders as dividends, those shareholders pay taxes again on their personal returns. So, all in all, the corporation and the owner are taxed separately. Once again, this structure makes sense for larger companies that want to reinvest profits, scale aggressively, or raise large amounts of outside capital. But for smaller businesses, the second layer of tax can be a major downside. Now let's look at S corporations. An S Corp offers the same limited liability protection benefit as a C Corp, where your personal assets are generally shielded from business lawsuits and debts. The big difference between C Corps and S Corps are how profits are taxed. Instead of being taxed at the corporate level, an S Corp uses pass-through taxation. That means the business itself doesn't pay federal income tax. Instead, profits and losses pass directly to the owners based on their percentage of ownership. And each owner reports that income on their personal tax return. This setup avoids double taxation entirely. Because of this, S-Corps are extremely popular with small businesses that want corporate liability protection, without the complexity and tax burden of a C-Corp. That said, S-Corps come with restrictions. First, they're limited to 100 shareholders. Second, all shareholders must be US citizens or residents. Third, you can't issue multiple classes of stock. So, which one is right for you? C-Corps are built for growth, outside investment, and scalability. They're ideal for companies that plan to raise capital, reinvest profits, or eventually go public. Just remember, C-Corps are subject to double taxation. S-Corps are built for simplicity and tax efficiency. They're often ideal for small businesses, solo founders, and closely held companies seeking liability protection and simple taxation without outside investors. S-Corps are subject to pass-through taxation. No matter which one you choose, it's important to understand that corporations come with formal requirements. Both C-Corps and S-Corps must hold annual shareholder meetings, maintained by law, and keep written records of major decisions. Ignoring these rules can weaken the liability protection the corporation is supposed to provide, so be sure to follow them closely. In conclusion, select the structure that suits your business the best. By intentionally structuring your business, you gain greater control, enhanced protection, and the opportunity for significant growth. Be sure to hit that like button, subscribe to the channel, and turn on that notification bell. We post weekly reels and new videos on Fridays to help you understand the finance world. Thank you all for watching, and remember to always save smart and invest smarter.